G'day folks, welcome back to another update, and today we're changing the format a bit. I'm going to be covering a few of these commodities, so hopefully you like the format. And today we're looking at high-grade copper, iron ore, gold, silver, US crude and platinum, and how they're impacted with the geopolitical tension currently happening around the Middle East. In terms of the outlook as of today, June 26, high-grade copper prices remain volatile amid supply constraints and steady demand, with forecasts averaging around $4.25 per pound for 2025. Iron ore market shows signs of stagnation with limited volatility. Prices have been mostly flat due to a combination of fundamental seasonal and geopolitical factors. Spot gold prices edged high to $33.28 per ounce, supported by a decline in the US dollar and treasury yields as markets monitor the Israel-Iran truce. Silver prices have surged past $35 per ounce, driven by demand outpacing supply and economic concerns, signaling a fundamental shift in precious metals landscape. Platinum prices rose to $13.21 per ounce in June, influenced by increased imports into China and expectations of market deficits. And US crude oil, despite Middle East tensions, prices fell over 7% due to ample global supply and increased US production, highlighting a shift in geopolitical energy landscape. Overall, precious metals are buoyed by safe haven demand, while industrial commodities face mixed pressures from supply dynamics and geopolitical factors. So starting off with high-grade copper, you can see on the monthly here, the first thing we look at is the trends, and the price is well above the moving averages on the price as well as the CCI broken above. But just do notice we've got this bearish divergence, lower highs versus high highs on the price, and that was bouncing off that resistance up there at 53.53. So we might see it fall further down with this bearish divergence still in play. Also note down here we've got a fair value gap that hasn't been penetrated yet, so there's a slight chance, and this could take years to play out, so I'm not suggesting you go short based on that, but there's a fair value gap that hasn't been filled yet based on that analysis there. In terms of the weekly, so bullish on the monthly. On the weekly it's also bullish. It's a fresh breakout on the CCI there. The price also is above the moving averages, and notice there it's filled that fair value gap quite easily, and that's what this fair value gap on the monthly is. So it's making that rebound further to the upside, but again it's approaching these two resistance points up here at 50.912 and 53.953 on the weekly. So bullish on the weekly and also bullish on the daily. Again, there's another fair value gap on the daily, so it may possibly break through that first resistance into that fair value gap to fill those orders. Again, bullish momentum based on the CCI and the price. If we go to the hourly chart, so taking long trades only according to where we are at the moment, you can see there we've got a fair value gap there. Now about 50% of that's been filled with the wick of that candle. It looks like the price is still rising, so we may fill the total fair value gap period up there. There was one down here, but notice that's been filled already with the action of those candles down there. So it just means we're waiting on that one to be filled possibly before taking a further retrace to the downside. Again, we've got that resistance up there to be aware of. So in terms of back testing, we've got here the hourly chart, so we take trades in the direction of the current daily trend, which is long. So from where we are at the moment on the hourly, you take long trades from that period back there. But what I've done, I've got the back testing started back here, and that was during that period there and about the 21st of May. This at the top one here is a stop loss approach, and the second strategy here is the average down approach. So you would have taken long trades based on the direction of the price as well as the CCI movement. Whenever it breaks above those respective moving averages, you take entries and you go in the direction of the daily trend. At the very latest, you would have closed out your position there on the daily when it hit that moving average range on the CCI, and you'll notice there the price did pull back as well. Now, in terms of an early warning exit, rather than waiting on the daily, you can actually read the hourly chart. And if I zoom in here for a moment, the first exit you would have made here would have been once you started noticing a bearish divergence, almost a double top there on the price. I'd consider that a double top versus declining CCI. And as soon as that starts heading down, you'll notice that divergence. The ideal area to get out would have been somewhere around there when it starts approaching that Fibonacci target range at 23.38%. And again, just to emphasize where we draw that 23.38% range, that's at Fibonacci 23.38% range. So you can actually exit it once it breaks into that moving average of the price, approaching that 23.38% range. You'll notice here the CCI kept falling, so that would have been a wise decision to take to exit the trade at that point there. Now again, staying in the trade longer, you would have gone into the trade again once you start seeing the price break higher and with the moving average band bending up like in that area there, along with the CCI. So once you start seeing both moving averages bending up in that area, you take long trades and stay in the trade again until you start noticing a break below the moving average bands, like you would have got out probably in that area again there. Now I've let it run through the whole period of that range, but that's just where you sort of get out of early exits. And the stop loss approach is generated about $1,380, and the average down is generated about $26,400. Now again, that's letting it run through the whole period. I'm not suggesting you do that. So where we are at the moment, you'll notice here the price is still making further upside. So bullish momentum, I'll mark it just to demonstrate. So further trending upwards versus the CCI is dropping. That's another bearish divergence. So again, it hasn't started to drop yet. As soon as it starts breaking below that moving average range, we can anticipate we would draw a Fibonacci range. So this could actually keep rising. So I'm not going to draw the Fibonacci necessarily, but as soon as that starts dropping below that moving average, then I'd draw a Fibonacci range in that range there. Okay, so that's how you start then exiting your positions once you start seeing that decline. So iron ore, first off, on the monthly, we're trapped in this range. It's pretty much consolidating, but at the moment it's below the moving average of the price. There's no CCI for it on the monthly, so somewhat bearish to consolidation on the monthly. On the weekly, we've got this, again, in this wider range, but it's still, you can see there it's still bearish on the moving averages of the price as well as the CCI, so still dropping. But however, notice on the daily, it's actually hit this resistance at 680 down here, and we may see a bounce because notice here we've got a increase or almost a double bottom or a triple bottom on the price with those wicks versus a increasing CCI trend to the upside. So we might see a bounce higher from there possibly if that price keeps rising from there on the daily. You can see it more clearly on the hourly chart. So again, using the daily as a reference, taking short trades predominantly, but I'd wait for that CCI to break below to take any short trades. But you can see here very clearly we've got this almost a triple bottom on the hourly chart on the price, hitting off that resistance at 680 versus higher lows on the CCI. Now if that eventuates and that continues rising from there, we would draw a Fibonacci, and we'd expect a retrace at the very minimum to that 23-38% range. That's a minimum target, and more than 90% of the time it hits that range, so just be aware of that. But again, don't go trading long until you'd see that daily as well break higher than that moving average range. So we always go by the trends. So this is the back testing for iron ore. Now I've gone short positions here. You can see there it's based, and I've started the back testing here around the February 26th, around during that period when it peaked and it broke below on the price moving averages and it broke below on the CCI as well. And what you look at is the moving average band. So when you start seeing it bend downwards like it did there, and it did there on the CCI as well, you start taking short trades. Now even though it broke above here, and you can see there's a bit of the moving averages on that bent higher, but notice the price was still bearish, so you would have not taken long trades until you start seeing the band also bend higher. This would have been a little area you would have taken some potential couple of long trades possibly, and I'll get to that in a second, but predominantly you would have taken short trades during that whole period. So what that looks like here on the back test of the stop loss approach and the average down, again, paying special attention to any divergence. You can see there that first period, you can see there in that little area there was lower lows on the price versus higher lows on the CCI. That was your first sign of a bullish divergence, and you would have got out of the trade once you started seeing the, zoom in there, as soon as you start price break and the moving average bend higher. So you would have stopped taking short trades around that period there, and at that point the stop loss approach generated about $20 and the average down approach generated about, what's that, $59. Now once you see them break down to the downside again, in alignment with the daily being bearish, you would have started taking short trades. And again, you started seeing long positions happening on the hourly, so you close out your positions during that period there. Now, notice here as well, this was a wider, where we are at the moment is a wider bullish divergence versus a truer bottom, as I said. And that would have been, at that point, that low was higher than that low there, and so was that low there. So that wasn't strictly a bullish divergence until such time as this point here, where that bounced off that resistance, and that was your first indication of a bullish divergence. So if you're in the trade going short during this period, you should have taken exits. But again, notice here during these little spikes, again, you could have closed out your positions in any one of those areas. But at the moment, as I've said in the previous chart, you would have, we're looking at a potential retrace to that point there, is that if the price starts moving from there and doesn't go any lower, that'll be your minimum retrace level. So that's how you read that and trade that. But overall, the stop loss approach, if you let it go through the whole period, and again, I'm not suggesting you do that, was below our break even. So you're down about $10, about break even on your $100,000 there. And the average down approach generated about $356. So looking at gold, that's been going quite nicely now for some time on the monthly, and it looks like it's still rising. There's no CCI for it, so we can't tell if there's any divergence on the monthly. However, do notice we've got these fair value gaps that haven't been filled yet. So again, this could be a very long-term play. We might see a pullback sometime in the next few years, possibly. Who knows how long it's going to take. So don't go placing short trades based on that alone. On the weekly, we've got this bearish divergence, lower highs versus higher highs in the price, and it looks like it's stagnating there. So that's probably a resistance up there as well. Let me just get rid of that for the moment. So there could be a resistance up there as well. I'll look at that and see if we can identify that if that doesn't go any higher. But the CCI is dropping off, and that's a weakening sign. It's currently consolidating in that little range there, those few weeks. But just be aware of that. Also, I've got these fair value gaps down here, which also coincide with the monthly. So just be aware. There is a resistance up there at 3,500, and again, it hasn't penetrated through that. If I zoom out, you'll notice here we've got a bearish divergence as well on the daily, and that's already hit its target range, and that would have been a Fibonacci range down to that low there, that 23.38%. The blue squares or rectangles are the Fibonacci retrace or the divergence, and the red rectangles are the fair value gaps that haven't been penetrated yet. If you look there more closely, we've got a fair value gap not yet filled in that little area in the last couple of days. So we might see a bounce up there sometime soon. But at the moment, we've also got this one down here. At the moment, the daily is showing a bearish momentum. Now, if we go to the hourly chart, again, what I've done here is we're going to be taking predominantly short trades at the moment based on the daily. You'll notice here the price is broken below, and so is the CCI. And here you can see there on the 1 hour chart, we've had a few bearish divergence, and I've marked each of those lower highs versus higher highs on the price, and each of those have dropped off in accordance with that divergence. Now, if we go to the back testing, what I'm going to demonstrate now is the long positions. The reason it's long is because you can see there, and I've started the back test here just to demonstrate from the 22nd of May during that period there. We take trades based on the direction of the price primarily, but you focus on the CCI in terms of a potential reversal. So you can see there, had you taken short trades during that period, you would have been in the red. Hence, we take predominantly the price movement. So you would have taken long trades during this period, short trades during that period, and then long trades again during this period. But always pay attention to the CCI to see how it reacts. Again, looking at the back test here, you can see on the hourly, you would have paid attention to those short positions there. So you would have closed out your long positions at each one of these periods where you saw or you noticed the bearish divergence. So the first identification would have been there when the price broke below the moving average band. So we're going long now. So you would have closed it out when the price started bending down. That was your first exit point. Go long again when the CCI and the price break higher. Close out your second position there when you saw that bearish divergence. And again, close out your going long again there, and then close out again your long positions when the price broke below, and so did the CCI after that bearish divergence. So looking at silver on the monthly, the price is above the moving averages, and so is the CCI. There's no divergence to show there. Although I do notice the fair value gap down there, which hasn't been filled. So again, similar to gold, we might see a bit of a retrace. Again, this could take years to play out, so don't go placing short orders on that. On the weekly, we've got a bullish momentum at the moment with both the CCI and the price above the moving averages. We did have a bearish divergence back here. That's already broken down and sort of hovered in that range of that 23-38% for a while. But at the moment, notice again, there's that fair value gap down there. And we've got another one currently more closely in this little range here. So we're very likely going to see a price break to the downside in the near term. And the CCI is already showing that on the weekly. On the daily, it's hit that resistance up there at 37.25. And again, there's another fair value gap which coincides with that one. And the CCI, you notice there as well, that's also a bearish divergence. Higher highs on the price versus lower highs on the CCI. So again, on the daily, bearish momentum, the CCI is below, even though the price is pulled back and it's just above that moving average range, so somewhat neutral positioning on the daily. Now, if we go to the 1 hour chart, again, be aware that we don't take long or short trades until we see the price and the CCI in alignment. But predominantly you would have been taking long trades during this period, and I'll show you the back test in a moment. But again, notice here on the 1 hour chart, we had this first pullback of a bearish divergence, and you can see that the wick of that candle broke into that range, and that's all you need to see with these 23-38% ranges. You just need to see it penetrated like that, and then it bounced out of there. It doesn't mean it's always going to fall right through. Sometimes it does. Other times it just touches it and it bounces out again. But looking at it more closely, you can see there we've got from that period again, if you extended that area, so we look at the CCI as well, that's still a bearish divergence, and that's already pulled back. And if we draw a target range, looks like it's already hit its range, and it has that 23-38% range. And I don't trade these 23-38% ranges. I just expect them to pull back at some point, and it gives you an early warning to get out of any long trades. If you're going long during this period, seeing these divergences, it tells you to get ready to exit the trade. Now at the moment on the hourly, it's showing bullish movement, so is the price on the CCI. So if we go to the back test, taking long positions, and what I've done here on the, let's get rid of that Fibonacci for a moment. So I've started the back test here from about the 20th of May, during that little period when you start seeing the price and the CCI break higher and the moving average bands bending higher. You start taking long trades, you'll notice the stop loss approach is about break even. You're down about almost $100 below our baseline of 100,000. But the average down approach is generated about 90,000, just ticked over 90,000 as we record. But again, notice you pay attention to these. If you're going long, you pay attention to these divergence. The first indication would have been that first peak there versus a lower high there on the CCI, and that's where you would have got out of the trade potentially. Now you would have let it run according to the price moving averages until you started seeing the price moving averages bend down, and that would have been after that second point there roughly. We drew a target range there, so you would have exited the trade somewhere there. Now you would have been up on the stop loss approach about 2,700 versus the average down approach. You would have been at about 55,000 there because you've averaged down quite a few contracts during that period. Now I'm not telling you should let it run through the whole period. Again, always pay attention to the divergence. Now in this case, the CCI was dropping off, and so was the price. So you probably would have avoided going long during that period until you started seeing it. You might have taken some long positions during that little period there when both the CCI and the price were trending higher with the moving averages, but then closing it out during that period there. So for US crude on the monthly, it's below the moving average band and on the price, but the CCI is broken into that moving average band, giving us a somewhat neutral positioning. So we may see a rise sometime in the near term. On the monthly, it's actually hit that support down there at 54.84. Notice up here we've got a fair value gap, so we are likely to see a price rise sometime, maybe in the next few months or even years. That's a long-term play. On the weekly here, let me just get rid of that. On the weekly here, we've got this. Sorry, let me just get rid of that. There we go. We've got this, in terms of price movement, it's actually broken above the moving average band in that wild spike, hit that fair value gap. Again, always pay attention to those fair value gaps. It's covered that, and then it's bounced back down again below the moving averages. And notice here we had a smaller fair value gap. That's already been covered as well. But notice here we've got a CCI broken above the moving average, but it's also pulling back in alignment with that bearish candle on the weekly. So somewhat neutral positioning on the weekly as well. On the daily, if I zoom out, first of all, again, it's below the moving averages on both the price and the CCI, so bearish momentum. And if I zoom out, you can see there it's already covered that fair value gap. We had a smaller fair value gap in there that was quickly covered as well. And we're in a, if I zoom out again, you can see there's another fair value gap down there near those support lines down there. And again, if we go to the 1 hour chart, more closely, taking short trades only at the moment, but you can see there we had a bearish divergence versus high highs on the price, and that broke out quite strongly. Now we've got this more recent, actually back here we had these fair value gaps. They were covered very quickly with these candles on the 1 hour chart, hit this support line, but you'll notice here we've got these fair value gaps in that range there I've highlighted in red. So very likely going to see a price bounce to that area, which it also confirms with this bullish divergence. So again, lower lows on the price versus to that same period, higher lows on the CCI. Now, looks like it's already started the bounce, so I'm going to draw a Fibonacci retrace on that from that low to that high, and that closely corresponds with that 23-38% range, just where that previous, or that resistance is at the moment. So we're expecting it to at least hit this minimum range there in the near term, but because of that fair value gap there, I'm going to suggest it's probably going to go higher. But again, don't go placing long orders yet. I don't trade these divergence or fair value gaps. I look at them as a potential area to get out of trades. I look predominantly at the trend. So here I'll be going predominantly short. So wait for this to break below that resistance and wait for the CCI to break lower to take short positions. I wouldn't be going long at this point. To take that long position now would be a bit of a gamble for me. That's just my principal rule. That's all I'm trying to explain to you. But in terms of back testing, I've gone long during this period around about the 20th or 21st of May, beginning back here when the price broke above the moving average band, and so did the CCI. You can see there the stop loss approach has generated losses. We're down about $7,500 there below our baseline, whereas the average down approach has generated about $38,000. Now you've got to be very careful with the average down. It looks enticing, but you've got to be very careful with your money management and getting out of trades where it makes sense. And that's why I'm explaining to you, if you're going long during this period, you can see they had a little bit of a bullish divergence there. That would have been nice. The price retraced back down. Let me just zoom in on that one. The price retraced below the moving average band of the price as well as the CCI, so you would have got out of the trade. That would have been about a break even at that point. You would have avoided going long there and started going long again during this period here. And again, wait for it to, there's no divergence there, but again, you would have closed it out at the very latest once you started breaking. In this period back here, you would have taken any profits off the table as soon as you see the CCI break into that moving average band, both there and there. Notice the exception though. There's a couple of exceptions when you exit the trades. When the price is going your direction and there's no divergence, like in this period here, you exit when the CCI breaks into that moving average band. And that gives you a somewhat earlier warning to get out. So had you got in there, you would have got in at that point and you would have got out with a small gain on that candle there. Got in again long there, there's no divergence. So you would have got in about that point there. But notice the CCI exit at that point was at the close of that candle. So you would have made those few points there. That would have saved you waiting until the price broke below the moving average band. So the exception to the rule is when the price is going in your favor and the CCI is also moving in alignment, i.e. there's no divergence, you exit with the CCI breaking into that moving average range. The only exception to the rule is when you see a divergence during this period, you let the price run, and you take exits when the price breaks below the moving average range, even though the CCI is declining. Now where we are at the moment, again another little, that would have been profitable had you taken long trades during that period, and you would have closed it out. So you would have gone in long at one of those little candles there, and you would have closed it out on that candle there where the CCI broke into that moving average range. Now in this case, you'll notice the CCI kept dropping. The price made a bit of a high there. That was your first indication of a bearish divergence. So if you were still in a trade at that point, you would have closed it out when the price broke below the moving average at that point around about this area here. Notice the CCI was still dropping, then started rising. You probably could have entered another trade there, and you would have closed it out again when the CCI broke into that range there, on that high there. So you would have made that little gain there. That's how you trade, looking at following divergence, but also following the trends of the price as well as the moving average band. Okay, lastly we'll look at platinum. Now on the monthly, we had a meteoric rise here currently in this month. There's no CCI for it. You can see that it's very bullish at the moment. However, just be aware, even though it's bullish on the monthly, always look at the lower time frames as well. The weekly here, we've got these massive fair value gaps unfilled, which means we're very likely going to see the price retrace back down to fill those orders. So be aware of that. Don't go strongly bullish yet. Always go in the direction of the CCI and depending on what time frame you're trading, always go in the direction of the CCI and the moving averages of the price chart as well. But at the moment, very bullish on the CCI and the price on the weekly there. On the daily, I'll zoom in on this one. Again, it's gone through that resistance up there at 1351. So blue skies at the moment. The CCI has broken into that moving average range after we had a bit of a slight weakening or consolidation in that range. But again, notice here, I'm going to mark all this right down. That's the first little fair value gap. But I'm going to mark them right down to this area here, which happens to be covering those fair value gaps there. Those little ones there have been covered. These ones have not. That's why I'm covering all that area. So that's the first thing you look at. Secondly, looking at a divergence. So what we've got here on the daily, you're looking at the CCIs dropping off. Now it hasn't completed yet. Very likely it's going to keep rising possibly, but that's a bearish divergence already. Now I'm not going to draw a target range, but in alignment with this fair value gap area down here, I'm going to suggest that if the price starts pulling back now, it's going to hit somewhere. I'm not going to just preliminarily draw. I'm not going to leave it there for now, but it's going to come back down to that area at the very least. So I'm going to delete that Fibonacci range until we start seeing the price start pulling back towards this moving average. The CCI is already pulling back, even though it's making a slight increase at the moment. So long as that CCI is still declining in alignment with or difference between diverging from the price, we're going to keep that bearish divergence in play. Now going to the 1 hour chart more closely. So today, taking predominantly long trades, remember we take predominantly long trades in alignment with the price chart. Here we've got the hourly chart. You can see there the CCI has been well and truly above the moving average range, and so is the price. But again, notice more closely, we've got this closer period of fair value gaps unfilled. If I zoom out, those ones there have been filled. You can see all those have been filled with that price action post that period. So they're the closest ones yet unfilled on the hourly we'll be looking out for. There's no divergence on that. That CCI is moving in alignment with the price, so there's no divergence there, but so safely going long during that period if you're trading on the hourly. Now, in terms of the back test, I've taken the stop loss on the average down approach back to around about the 3rd of May, which happens to be this period back here when if I zoom out a bit, where the price and the CCI are both trending higher. So I've started the back test there, and both the stop loss approach and the average down approach are doing quite nicely. One thing to highlight as well with the stop loss approach, when the price moves in a direction like that strongly, the stop loss approach works okay. Okay, just be aware of that. Whenever you see a lot of pullbacks, that's where you get stopped out. So just be aware of that, and that's why I'm not going to tell you that you must trade the average down approach, but I'm demonstrating both methods and giving you the pros and cons. The average down approach works well so long as you strictly follow the bearish divergence rule. So again, during this period, if you're going long during that period based on the CCI and the price, you would have taken those long positions there. So that was 19th of May. But notice here as well, we had a bearish divergence. So again, during that period, let me just zoom in on that one. So that would have been your first indication of a bearish divergence. Let me draw those trend lines. So that your first highs there were lower versus the price. That was your first indication of a bearish divergence. So now you've got your red flags currently in place. So even though you're going long, you follow the price on the 1 hour time frame. Now the price kept rising. It broke below there, and the CCI kept dropping. Now you could have possibly closed out your position there. Notice there were no trades made there, and then re-entered once you start seeing the price break higher. But notice the CCI is still dropping. The price kept going, and then you start seeing the price drop below the moving average range. And that's where you would have taken, exited your trades as well. The price dropped again further, then it started moving higher again. You possibly could have taken another long entry there, both the CCI and the price of moving higher. But again, you would have just extended that to that level there in alignment with the divergence rules. Then you started seeing the price moving averages started bending down again. So theoretically, you would not have taken long trades during that period when you start seeing the moving averages bend down. Let it go, let it go, let it go. Don't enter any long trades. And during that period, you wouldn't have entered any long trades anyway, until such time as this period here. And that coincided with this period back here on the daily. You start seeing the moving averages bend higher, the CCI bending higher as well, and you started taking long trades during that period. And that's where the average down approach would have worked nicely had you averaged down with the price moving higher as well. Again, then you started seeing the CCI drop off. From that point, that was your first indication of a bearish divergence. But you let it go because the price is still above the moving averages on the price chart. Your second indication of a bearish divergence. The price is still above the moving averages, let it go. And then there's another bearish divergence there. Price is still above the moving averages. Even if you drew it to that level, that's still a bearish divergence. You get the idea. Another bearish divergence. The price still maintaining above the moving averages, let it go. Until such time you see both the price and the CCI dropping below the moving averages like it did there. So you would have got out the very latest at that point there. Notice there on the daily chart, that's where the price also broke into that moving average range. But the hourly gives you an early warning. Let it go. You would have got into that period back here when the price and the CCI were trending higher until where we are at the moment. And the latest entry you would have made would have been at that point there. But again, notice here the price is above the moving averages, even though the CCI has broken into that moving average range, giving you a somewhat early warning. So you could have got into a long position there. That would have paid off as well. And again, if you're in this trade at the moment, you'd wait for when, you tell me, you'd wait for that CCI to break into that moving average range to take your profits off the table if you got into the position back here. That would have given you a nice little gain on both the stop loss and the average down approach. So let me know if you prefer this consolidated approach to reviewing the charts, or should I stick to the reviewing individual instruments? If you're new to trading, we're now including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. And if you enjoy the content, subscribe at least on a free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you now in next video.